Cool. Thank you everyone for joining us on another Wednesday. Here with Multifamily Freedom Chasers. Here just to go over our every 2 weeks as we do with broker and underwriting. Definitely something we'd love to do, and excited to get back into the rhythm of things. Um, my name is Edward, as you can see here, based out of lovely and chaotic Los Angeles, California. Been in real estate about 5, 6 years now, from operating my own brokerage to property management to owning property myself and managing it here in um, California and LA, to doing deals outside in Florida. And Kevin and I, we can dive more into that. But today, just want to introduce ourselves, get into the um, basics of underwriting and broker outreach. And glad to have everyone here. A few of the housekeeping stuff that we I want to mention is if you can turn the camera on, that's greatly appreciated. And then always remember there is a chat. You guys can chat with each other, connect, put your info in there. It's a great way to network with everyone, because as much as I wish we did, we don't have time for everyone to introduce themselves on the call, but it's a great way to connect in the chat. So utilize it. And then if you have questions, feel free to put them down there. We're pretty good at keeping our eye on the chat, so we can answer those as well throughout this hour. And then if we don't get to it, or we just gonna have the questions for the end, we'll definitely address it then. Kevin, you want to introduce yourself? You're on
Thank
mute.
you. Yep. Thank you,
Oh,
Ed. My
there you
name is Kevin Kohler. I'm a commercial and residential real estate team owner out in lovely South Florida. We operate on a commercial level across the entire country, looking for deals that make sense for our clients and helping connect sellers to the right buyer pools. I've been doing it for 7 years now, and commercial real estate for about four of those seven. And through that, we've grown into doing real estate syndications, and we are launching our real estate investment fund by the end of this month, actually. So it's been exciting. There's always room for growth here. And despite whatever is going on in the market, as long as we keep our eye on the deals and the numbers of those deals, you're going to be able to find opportunities at any point in time, any market, any point of the cycle. And we're happy to have you guys here and kind of pull the curtain back on the broker side of the multifamily space and commercial real estate investing.
And here's just an intro to the team for anyone that's not familiar with everyone. You'll see us all on the calls throughout the week, every other week. Um, so here's our handles. Obviously, Instagram's an easy way to connect with us. Always a great way to kind of see what everyone's up to. Keep track of when the next calls are, and any other exciting stuff, and the activations of guests. I think that's pretty um, good too, because we've had some pretty awesome guests over the year and a half we've been doing this. So I do recommend checking those out, and I'll show you guys where in a little bit. But this is the schedule we have: alternating Mondays and alternating Wednesdays. Same time to make it easy, and depending the week, you'll get one or the other. So either finance, management, the activation Zoom, or what we're doing tonight, which is a broker outreach and deal sourcing and underwriting. And like I mentioned, YouTube, Spotify, Instagram, Facebook, WhatsApp, great ways to connect with us, watch some of the old Zooms. There's a lot on there. Actually, as I look back, I'm like, wow, we've done a lot of these. So definitely good content there, and a good way to kind of get an idea of what we've discussed. If you have any questions, it's a great way to just recap, and can never, you might pick up something new if you missed anything on the Zoom you're on at the moment. And then, real quick, here's a WhatsApp group. Another great way, as I mentioned earlier, to connect with people, network. You never know who knows who or who's in your backyard. You know, it could be a couple blocks away, miles away, whatever it is. Just a great way to connect and meet each other, and ideally do a deal together. That's the plan. So one question that what we kind of want to discuss today really was just general underwriting 101, really sticking to the basics, getting an idea of what to look for, what you need, and especially now where market's in a really interesting place, and I'd be curious to hear other people's thoughts, and definitely Kevin, like what you've seen a lot um, that's going on. But we really want to make sure that we're on the same page, kind of getting the basics down and kickstarting this kind of wave of direction we want to go with, starting from the beginning, really laying that groundwork. And if you have any questions, like I mentioned, please do let us know in the chat, and we can just kind of discuss from there. Kevin, is there anything specific you want to mention before we get started?
Um, not particularly. What I would say is again, as we start looking at a potential opportunity, we have to remember certain things of how we're looking at it. So depending on the asset class, and for this Zoom in particular, we focus on multifamily, understanding how we're entering into the deal, like the terms you're going to be acquiring it, but also pacing yourself forwards and thinking about the terms that you're going to want to exit the deal and what that time frame is. So in terms of syndications, a lot of the time we're looking at anywhere between 3 and 7 years. So that's a pretty wide range. And knowing who that end user will be when you're selling it, because the big terminology we love to throw around is value add this and value add that. You have to be able to determine, if you're doing your value add via renovations, are you renovating 100% of your property? Because if so, who's going to buy it next? Because the normal syndicator is not. There's no more meat on the bone for them to go after. Is it going to be an institutional, an insurance company, a church, something of that, a big organization like that? They will only look at deals over a certain size. So we have to start to determine who that end buyer will be in the future, as we determine that the deal is worth deep dives on the underwrite. So I just kind of preface it with that fact.
Yeah, definitely. And I think another big thing too is especially as I'm sure a lot of people kind of got burned, or maybe getting burned soon, that acquired while rates were very low, is have your ideal exit strategy, have your optimistic exit strategy, and then have your worst case scenario where, okay, do we have another alternative if the XYZ ABC doesn't work? Because unfortunately, in real estate, once the deal is acquired, you can't change a lot of the things that, um, in regards to the price, the terms, the length of the loan. Like there's a lot of things you don't have control over. Unfortunately, as much as we like to believe we do, and as much as we think we have a phenomenal game plan, um, stuff happens, for the easiest way to put it. So that's kind of where one thing that a lot of people are gonna be experiencing, where rates are double, if not more, than what they initially acquired and even projected at on the back end. And if you look at past videos and calls we've done, you'll be able to see how we underwrite that. And that's definitely something we can go over to on a future call again, or if anyone has specific questions. Um, one thing, so one thing I want to show here, that just for a reference point, this is the calculator that we use um, to underwrite most of our deals. I'm not going to, at least right now, my intention is not to go and deep dive into a deal. That's not the reason for pulling this up. Really, it is to show this is um what we're looking for, what we need, what we're using to underwrite, and just kind of using it as a way to navigate and get that initial information from a broker. Um, and when it comes to this itself, like the underwriting, it definitely does help contacting, communicating, and building that rapport with the broker when you're able to kind of nitpick and understand the underwriting and even know initially what you want to look for. Um, for example, if you see one thing I like to do early on when I receive any documents is really just scan through it and see is there any numbers that are outliers or out like even over 12, 6 to 12 month period, this one number shoot up drastically, and it's like, oh hey, I'm curious about this. Because then it just starts a conversation, you get more information, and that opens up more questions. So just different ways to build that rapport can definitely be created just by an initial scan of a document or the documents you receive from a broker.
Yeah, and to add on to that, it is that those initial documents you can get. So myself and other brokers, we get, some of us are work in areas like South Florida is a little bit notorious for kind of back of the napkin financials on some of these buildings, or the owners families had it forever, and they don't, it's all mingled together, and they don't know how much they spend. They just know they make money every month, and then you have to like extract the information from them to really understand what are the baseline expenses that they're paying on the property, what is the rent roll at. Because I mean, I'm having a conversation right now with a seller where they're like, I don't know, we make 18,000 a month, and I'm like, all right, but like, how much from each unit, and what are the concessions you're doing, and where are the leases structured at? And they're like, oh, they're just month to month, and we just make 18,000 a month, and you have to dig in, because having the top level data, sure, you can start to figure something out, but you're gonna once you start once you start an underwrite based on assumptions, then it's just, a phrase I like to use, it's just toilet paper. So it doesn't take you to that comfort zone that you're going to be able to present it to a bank, that you're going to present it to investors. You need them to be able to do the hard work a little bit sometimes to accumulate the data. If we can, what we always harp on, Ed, this is a T12, the trailing 12 months P&L statements, the rent roll as the newest version possible. If they have any insurance data that they're willing to provide, especially for Florida markets and any coastal markets. I mean, Houston, they're going through this a lot now, especially with Beryl and previous storms hitting them. Um, you have to be able to get as much of those pieces of information as possible to actually do your job as an underwriter. Um, and what I would also say, like on this calculator that you have on the screen, Ed, if you could scroll down just a little bit, at the expenses there, you'll see the total expenses and then the expenses percentage. So, the ideal, of course, is to try and find something that is going to be starting out at, 50% or less in expenses. And the closer we can see the deal actually getting to 30%, which is kind of the gold number, the better. However, in current day and age and current environment, it's near impossible to find a deal that's actually at 30, especially in South Florida. But again, understanding those baselines to then know how much opportunity is left for you and your team to get out of the deal, and then by reviewing these numbers up front, even just sometimes those first glances, you'll be able to determine, is the value add in the opportunity based upon renovation and increasing the rent roll? Is it just super poorly managed, and just efficient management might be able to help you increase your NOI? But if you can't increase the NOI, it's just not a deal. So, Georgina, I saw you raise your hand.
Yes. So if, let's say, the percentage is high, like 65%, is that, I'm not saying that's a no-go on the deal, but is that something like a good thing, because then maybe you can bring expenses down?
Yes, it could be construed as a very good opportunity lying in wait. And I've also seen buildings for sale where it's high and there's no way to get it down. And then those are the ones where you just kind of feel a little bit of pity for the seller, because you're like, man, I can't help you. I hope you can help yourself. but being able to see it, and sometimes that's also like where you can see, hey, the management company's paid way too high of a percentage. They're, doing tons of fees. There's costs that are buried in here that maybe a new ownership can come in and carve back out. If they have floating rate debt and the debt is just going sky high, then of course that hurts their expense ratios. So all those little things could play into it, but definitely anything that's higher, the first thought is this a value, or is this an opportunity, before you just say, hey, no, this is garbage, let me move on.
Two points I want to add to that too. One is when looking at the expense, don't look at the percentage as, oh, it's low, it's a great opportunity, oh, it's high, it's bad. Because remember, the percentage is relative to the income. What is the situation of the income? If the income is like stable, normal, there's no high vacancy, there isn't high concessions, and you're not too far off of market rent, like the loss of lease isn't terrible, then the expense ratio itself carries more accuracy. Carries more weight. But if it's just a, hey, there's 60% occupancy, 40% vacancy, no matter what, your expense ratio is going to look astronomically high just because you're not making enough. Remember, your tax number is your tax number, whether it's 100% rented out or 50% rented out. That number doesn't change. Now, obviously, what does change though is the impact that has in the ratio and the percentage it carries compared to that income, right? So keep that in mind too. The percentage is a good guiding factor, but we've looked at multiple properties, and I'm sure you guys have seen this too, where if there's a high vacancy, whether it's repair related, damage related, fire, whatever the case is, your expense actual percentage, I don't, I'm saying don't ignore it, but just remember, like, hey, there's other factors that contribute to that. And then the second thing too, when you're looking at that same scenario with the NOI, if you're going the whole traditional, this is the NOI, this is the cap rate, this is what the value is, you're gonna be talking apples and oranges, just because there's so many factors affecting the actual value, because there's perceived value too of those units, whether they're collecting rent or not is not the point. They're there, hopefully in one piece, not always, but they're still there. You don't have to get permits for them. You just have to rehab, which you will factor elsewhere. You know what I mean?
Yeah.
Hope that answered that question. Any follow up with
Mike,
that before we go to Michael?
No, thank you.
Wait, Kevin?
now I was going to say, Michael's got your hand up, so what's your question?
Yeah, go for it, Michael. I know you're driving. Careful there.
Yeah. Can you guys hear me?
Yep, we can.
Okay, so my question is, so I'm new, obviously, to multifamily and trying to find a deal and all that stuff. I'm not, we don't have a business set up for this, type of operation, but I finally found a nice deal that I like out here, and there's an NDA on it. The broker has the exclusive listing on the NDA, so I'm not super concerned there. But then when I enter, my information, it's like, oh, what's your company? What's your email? And what's your position? And so I'm kind of stuck at how to approach that, or how to break that boundary there
Yeah,
and still look credible to the broker.
sure. So there's a couple of ways to do that. If your team that you've kind of assembled hasn't incorporated in any way, or nobody has a company that they can use, honestly, sometimes it's just as good to put TBD on the entity name, and then still for your title put principal, and or manager. And because then, if the broker, which usually they don't even ask why or who, but if they call you back and they're like, hey man, you filled this NDA but you put TBD, I need to have a company name, then your response should be very simple. We create a new company for every property we purchase, and we don't know the name of that company yet until we know your property's a good deal.
Okay.
So that way, because again, when we're doing our acquisitions, we want our entities to be single purpose. And again, I'm not an attorney or an accountant. You should always check with those guys for the right advice on this. But in my experience, this is what we've seen: is you want to have a single purpose entity that limits the liability of that acquisition. So, like for example, I'm like 90% through the negotiation of another apartment complex in the Panhandle, and even in the contract, it just says that, there's a placeholder entity that it's going to be assigned over before closing to a different
Okay,
entity because we haven't even decided the name of it yet.
gotcha.
And the seller and the broker, they didn't even question that. All they asked for us is that we said in our verbiage of the PSA that the assignability is limited to the entity that we still control, and they don't want us to go out and wholesale the deal. And we were like, that's fine, because we're not going to wholesale the deal. We want it.
Right.
So yeah, that would be your best workaround. Say you're the manager of entity TBD, and then if you don't, since you don't have an entity or a domain, then probably have a Gmail address that's like Michael Investments or whatever, and
Right.
then that way you're separated out from just like your personal email.
Right.
But
Yeah. I was
be
like, I didn't want to put my work email on there or my business email.
Right. Right.
Right.
Yeah. And you don't want to mingle it together with any other business. And I mean, if you're doing other things, that's great, because usually at some point the broker, if they're going to take an LOI of yours seriously, the next step is they're going to ask you for a bio, of the managers or the principals of that entity. And so you're going to have to know something, give them some sort of a piece of paper that is going to say that, you do this, you do that, whatever, and to add credence, to add credibility to your pitch to take the deal.
Okay. And then follow up on that. So what if I'm to the point where I haven't even put together a full team yet? Then am I ahead of myself on even trying to get an NDA signed or?
No, the NDA is the first thing, and that's just the broker protecting themselves, because they're about to
Mhm.
provide you financial sensitive information of the seller, sometimes tax returns and other things.
Right.
So the sellers demand an NDA to protect themselves. Um, it's the very simple first thing. So don't worry about if you have a team. I mean, a good example of that is, Ed and I, we didn't have a team when we started working on our acquisition last year in the Panhandle. It's an $18 million deal, and we assembled the team after the LOI was sent.
Okay.
So the timing will come into what moment makes sense for you.
Hmm.
Um, but right now it's more about seeing if it's even an opportunity to pitch to a team.
Right.
You
Right.
know,
Okay.
because like when you get a KP and other stuff, you don't want to waste their time, and
Right.
they're not going to just spin their wheels with you on a deal unless you've done some diligence work to prove to them that it's worth digging into.
Right.
Because the guys who are doing KP, like, they're pitched deals every day, so yours has to be the golden goose for them to want to say, you know what, I'll sign on your loan versus a different loan. But yeah, don't you're kind of, those are limiting beliefs that are causing you to get nervous about the analysis of the deal, and I would say
Right.
just sign away.
Hmm.
I've on my listings, the same thing. I've got NDA set up before I even have conversations with people.
And like,
So
just if they don't respond to me, it's like, okay, just move on or just keep following up or.
if they don't respond, keep following up. Brokers, we get overloaded. We're jerks sometimes. Just
Mhm.
the more persistent you are, the more that we'll realize that we need to answer you to get you off
Okay.
our back. I
Right.
mean,
Got
that's
you.
the easiest way of putting it.
Yeah.
But,
Okay. Makes sense.
yeah, depending on if that broker has an administrative assistant or not, they could truly just be overloaded and going from meeting to meeting and just trying to answer calls and get back to people. And that's easy to have, buyers slip through the cracks.
Okay.
Also, to keep in mind with the
Awesome.
NDA, it really is just for a part of the NDA as well is the broker the best way to kill a deal is to show way more people than you have control over right away. And if everyone's seen it, and maybe two reasons. One, if the broker's like, maybe we're priced a little high and now we're just kind of getting some feelers out, but at least you could get some responses and say to the seller, hey, this is the feedback I'm getting initially. But also with the NDA is, like, let's be fair, it's going to weed people out naturally. Like, you are gonna weed out the people who, let's be fair, if you, the same person that's asking your question may not have someone to ask the same question to and not sign it at all. And now you've all of a sudden, did he leave? I think so. But regardless, I'll
Yeah.
finish answering. Is you're gonna have the situation of, hey, if they're not serious enough to sign an NDA, they're not serious enough to follow up with me regarding the deal. And then to this point of, do you follow up? Yeah, following up the second time just shows you're more serious than
Yeah.
the person who doesn't too.
And the last point I'll say on that is, as a listing broker, we can be using the NDAs also as just a metric to show our sellers all the work we're doing. Like all the websites, just like if you're looking to buy a house, Zillow will tell you like how many views and favorites and all that stuff. The commercial brokerage sites, we have our own metrics of how many people have registered their information, how many people have signed the NDAs, how many people have downloaded our offering memorandums. These are all statistics that we like to give our sellers to show that we're hustling on their behalf and as their fiduciaries. So, and when an NDA presents itself, that's fine. I would actually probably get a little bit more nervous if there's a deal. I would get more nervous if there was a deal that they don't ask for NDAs or anything, because then that's probably telling me either the broker is more new at everything, or they're just don't have a lot of information to give you, and so it goes both ways. But yeah, NDAs are just used to help make sure that you're serious.
Last thing I want to say before your question is, what is the most valuable thing in the world right now? Data. Like, they're just collecting information. You're now on their list, whether you like it or not. You said one. I'm sure Kevin, you way more than me, but like, how many more lists and like buyers lists or agents lists or like emails you get from people you may have talked to one time and signed one NDA forever ago, and you're still getting emails from them. That's also a part of the equation of, trust me, if I could get every person in the world's email, I'd be a happy man. Like, let's be fair. But because at the end of the day, you're collecting data and information.
Yeah.
That's also part of it.
Yeah. So hopefully that answered everything, Michael. Georgina, you have a
Yeah, I
question?
had a comment and then I have a question. So when you sign the NDA too, like if it's for the deal room through the broker and they're just collecting, they can see how many different NDAs you've signed, and right? So they're like collecting that data to see how active you are in their area.
Yes. If I have multiple listings in town and I see you signed NDAs to all of them, I'm probably going to give you a call and try and understand really what your buy box is, so that way I can figure out which of these deals that you'd be best for, or at least I know you're should be taken more seriously. I agree.
Well, I mean, like even if it's not all in the same time, but over the course of a year, you might have signed one 8 months ago, and then you signed another one like 6 months ago, and then now another one. So it's like you're kind of a consistent presence on
Yeah,
there.
you're continually hunting and not giving up. The people that sign it and you never hear from them again, I mean, they're just opportunistic. But if somebody's going to continue in a market and an MSA and try and identify a deal consistently, then I know that they're actually hunting and they've already identified their area that they want to buy in, and they're just trying to find the right one that fits.
I did have a question about where is your area? Do you guys only just stick with Florida?
So I'll answer that one first, and the answer is no. I'm actually location agnostic. I look for generally, Sun Belt states, but I'm not scared of the Midwest. But like Georgia, Florida, Tennessee, the Carolinas, and Texas, are big options for us. Texas, I have, I hate looking at Texas, to be honest, because I feel like everybody does. And it's a non-disclosure state, which means that sale prices don't have to be disclosed, and you have to work with title companies and other groups to be able to actually understand what the tax situation would be after you buy a property. A lot of syndicators don't know that. They buy it willy-nilly, and then 2 years later they're underwater and they have to sell. So that's why there's always deals in Texas, because Texas creates distress. It also does have great opportunities because it's cheap build cost, cheap labor, cheap lots of things, and cheap door value. Like you can buy deals in certain cities for like $30,000-$40,000 a door. In South Florida, you're paying 200 plus generally. So it all just changes on the market. But really for us, we do focus heavily on Florida, and then Georgia, Tennessee, Carolinas, and Texas. But
So I in the same boat as Kevin. Obviously, like we love those areas. I'm a little being kind of it is my backyard. I'm not gonna say no to LA, even though most people will. Maybe some parts of LA I won't. Like one particular city specifically. But generally speaking, I'd buy there. I don't care. Pasadena is what I'm worried about because so here's a
yeah,
joke, or here's a fun part about Pasadena. Um, I had an agent on a property I was looking at out there. It was a 12 unit. They're like, as bad as you think California is, generally speaking, with the laws, Pasadena is the worst city in California with the laws. I'm like, okay, so we're avoiding that. Everywhere else, I'm game. Pasadena, as much as I love the city, I'm okay. We're good without that. And then see, you had a question there. We'll get to it in a second. But yeah, I still like all the cities and areas, states that Kevin mentioned. I like LA because it is my backyard. And it helps that I'm licensed here in management, all that stuff. I can do it here. So personally, I'm not going to say no to that either. Especially if I find a good enough deal, I will jump on it. Absolutely.
Okay, so to
Ooh,
kind of piggyback off of that, how you're talking about with management. Now, if you are to buy um, a complex, let's say 100 units, now would you hire your own property management to run it, or is that a conflict of interest?
if it, no matter where the property is, we would probably have a company that manages it. Um, Mostly because, especially when it comes to being the GP on it, it makes it a lot cleaner and a lot easier. Now, I'm not saying you can't do the property management. It's something that like we've talked about too. Personally, it depends on your experience and your confidence. Like if it's a property management company you started yesterday for this reason, I'd say absolutely not. It's way too risky from the what kind of like what you owe the fiduciary duty to the investors essentially. Like don't try to bite off more than you could chew day one. Now if
yeah,
you've had the company around and have the experience and have managed 20, 30, 50, 100 units, then by all means, like who better then? Because no one cares more than you will. But you still need some form of like that checks and balances, multiple branches of like, okay, you still have asset management that's gonna you're not babysitting, you're not saying you don't trust them, but you want that difference of opinion where, hey, that's how you run your property management. But then now we have also the LPs. The bottom line is you owe the LPs. What it boils down to. So like,
yeah.
do you trust yourself to do it? Okay, great. If not, then absolutely just hire out. Also, one thing we learned was is the lender okay with it? Because that's a surprise you don't want to have at the 90 at the last minute, like 11th hour, whatever analogy you want to make, because there's a lending requirement on that too. And if you don't even meet that, you'd rather know sooner than later. So there's a lot of factors. Simply put, is if you can and have the experience, I don't see why not. If
Right.
you don't have the experience, don't force it. You're just gonna stress yourself out and make it much more complicated and um you're taking on more risk, to be fair.
And
Not that
and
hiring another property management company isn't risky. It can be. But if they've had the experience of years, 20 years, makes it a
Yeah.
lot more
And
confidence.
to add on to that, I mean, we'll use our own story on that, just like Ed had touched on. Like when we were buying our property in the Florida Panhandle in Northwest Florida, between the GP team, there were already over 200 doors under management internally through two different management companies. So we got together and we said, we could do this very easily, pooling our resources together. So let's go do that. And that way we'd be, more granular, more hands-on, serving our LPs better that way, and making sure it was a lean, efficient machine taking care of the property, and executing, maintenance guys executing our business plan to the T and all that. And then the lender came back and said, well, how close is your nearest regional office? And we were like, well, it's going to be the leasing office once you say yes, like 0 feet, and they're like, no, 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 we want a pre-existing regional office within like 100 miles. And we were like, oh, well, we don't have that, you know. So we ended up turning that around very quickly, and we went out and we selected a very large publicly traded company that managed over 20,000 doors in the state of Florida alone. And so we just said, okay, lender, you're trying to beat us down here. Here's somebody you cannot say no to, because they're
Yeah,
taking
mess
care.
with us now.
Yeah, and because we did not want the deal to fall apart for some stupid reason like that. And we weren't trying to internalize the management to like make more income. We wanted that forensic level of micromanaging the deal to make sure that we hit our business plan. So we closed on that deal in March, and we've spent the last 4 or 5 months now working with that company, ensuring that they understand that we're going to be continually staying forensic at the asset manager level. And there's definitely been some friction points because they're used to more institutional investors and larger investors that don't look that closely, and just pay the bills and whatever. But we're questioning every little charge, every technology fee they bill back to us, every reimbursable expense. I mean, we got at them because they were taking their team out for like paid lunches, and I'm like, I don't even do that myself. Like, how are you gonna, how are you gonna write off lunch and then bill us for it? Like, if you want to do it, if you want to pay for your employees' lunch, you pay for your employees' lunch out of your management fee, not a reimbursable expense. And that caught them off guard. But they quickly adjusted and got used to how we're doing things because we're talking to them about scaling together. So yeah, I would say it doesn't create a conflict of interest, except in that example that Ed gave of you opening the company for the purpose of managing the deal. Because as a GP, your first fiduciary duty is to your investors. You're creating a company that has shareholders, and those shareholders deserve the best return. And if that best return is internalized, that's great. If not, then don't do it.
Mm-hmm. Absolutely agree.
So, Ronald, you have a question, sir?
Yeah. This was a question. This was actually a comment that I was going to say about something that was discussed a little while ago when I first raised my hand, but the conversation kept progressing. So
No worries.
I was going to say something that I have found to be a good tactic that I've started to employ in even if I look at a deal, for example, if it's out of my buy box, let's just say it's 300 units, and I'm only looking for units that are up to 180 or 200, because I'm looking to get into my first deal. I don't want to bite off more than I can chew. What I'll do is I'll still sign the confidentiality agreement, and I'll still download the docs, because what I know happens is the broker gets a notification that I viewed their documents. And then usually that starts a connection with that broker where they'll reach out to say, hey, I saw that you downloaded the docs. I wanted to know if you were interested, wanted to find out any more information. Or what I'll do is, since the broker will already see on their system, they'll get a notification that I downloaded the docs, I signed a confidentiality agreement. I have templates that I created in my Google, my Gmail business account. Different things saying the deal is too large, or it's not in my buy box or not in my market. So then I could just always go in and click the template and then just put the person's name, put whatever market it's in, that kind of thing, just customize it slightly with just a few keystrokes and then send it off. So I'll tell them, yeah, I'll respond back and say, thanks, but just wanted to respond back. This deal's not really in my market, or it's not in my buy box because of XYZ reasons. These are my buy box criteria. And I list that below. And normally what that does is starts a connection with the broker, and they'll respond back and say, thanks for letting us know. We'll keep you in mind, and we'll send over some deals that more closely align with your buying criteria. So that, even if I'm not interested in a deal, I still go and sign that confidentiality agreement, download the docs. Even if I'm just going to download and delete them, they don't know that. Their system's just going to show that I access the document center.
Now, I would say, to play devil's advocate on that, when people do that to me, and generally you get to a point as a broker of knowing when it's a templated response, that frustrates me more, because then if you say like, hey, this deal is too big, I'd be like, well, the door count was on the initial information. Like, why'd you even bother clicking?
Well, not
Right.
door count. I'll say the price point. We're looking up to 15 million here. When I look at I see the door count, but then based off of the price per unit or something like that, or with the whisper price, because then I'll ask, because a lot of the OMs don't actually have the purchase price on it, the
Right.
ones that I've seen. So then I respond back with an email asking certain questions. What's the whisper price on this? What's the cap rate? How long has the seller owned the property? What's the seller's motivation for selling? Is there anything on the OM that I should know that you'd like to share, that's additional information, things like that. And then
Yeah.
at that point, when I see if they come back, okay, they're whisper prices in the mid 20 millions, and I'm only looking to go up to 15 million, then I can respond back and say, well, this is outside of our buy box. We're in this market, we're only looking for deals that going up to 15 million. These are the criteria that we're looking for.
That I can agree with 100% without any problems. And I mean, I just did that myself last week. I was looking at a property in South Florida. I got really excited. It's new construction. It's in a hot area, and started talking to the broker, and like like you said, the OM was priced to market, so there's no pricing actually disclosed on it, and you have to ask about the whisper. I started to push on that, and they ended up wanting about $350,000 or $360,000 per door. And
Wow.
I was like, I think if we could be in the high twos, we could talk, like 299 even, but not there. Like, we're not going to pay $90 million. So it is the right way of doing it, because then they have to provide the additional information, and then you're able to beat it down from there. But I've gotten stuff where like people download and they're like, oh, I was looking for garden style, and I'm like, yeah, this isn't even a garden style architecture. Like, why are you asking about this property? And then they'll send their like buy box PDF or whatever, and I'm like, you could have just emailed me blindly with your buy box, and I would be just as happy to look at it and figure something out, versus thinking, telling a seller like, hey, I got somebody that just registered, and let me go, talk to them about the deal.
Right.
Um,
The other
but
reason that I
yeah,
do that also is because if I know other people that may be interested in that kind of property, once I take a look at the OM, I can pass it along to them and say, hey, this doesn't fit my buy box, but I may know someone who it will fit. And at that point, I can refer it back, which also creates a connection with myself, the broker, and the other person. And I've done that also. I've actually referred someone to a deal. I don't know if they actually took it across the finish line. I've got to follow up, but I did actually do that at another instance.
no, I'm trying. Yeah, I mean,
Careful with how much of that. Careful with how you word that to the agent if you did just sign an NDA. I
Well,
know
I
some
ask,
maybe more
are
strict on it
this
too.
doesn't
Yeah,
fit my buy box, but would you be okay if I share this with someone who I think would be interested in this, or I could refer them over to you. That's how I usually word it.
yeah. Just mentioning for generally everyone else. Yeah.
No, but that's
Don't
good. Thank
just
you.
pass the deal around and let this agent know. Oh, I shared it with my 500 people in my email blast. Like,
Oh, no, 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 no.
you're
I'll always
definitely not
ask
gonna make a
first.
friend there. Yeah,
Because
yeah.
I
I
always
mean,
ask
because
first because I don't want to tank a relationship that I'm trying to build with that broker.
and not only that, the NDA specifically is about confidentiality.
Yep.
So,
Hmm.
so if you're actually telling them, hey, I know you gave me this confidential information, but I'm going to send it over to my buddies over here that are not that affiliated to me. Some sellers that maybe they really don't like that how that goes, and even if the buyer is like an actual buyer, they might want to get litigious instead.
Right.
Um, so protect yourself first and foremost. But yeah, the best thing is to asking them, hey, can I refer this over to somebody I know that hasn't seen your, your posting or whatever, and then have that person sign the NDA themselves. It's usually the safest bet.
That's what I did, and the broker responded back and say, "Sure, no problem.
Yeah.
Thanks for sharing that information. Referring that person
Yeah.
to me." So, I then once I got that confirmation, it was okay. I forwarded the information and included the broker's contact info in the email that I sent over to the individual.
Yep. Georgina.
So yeah, I was gonna comment about that. I wanted to share information with a KP, and I asked the broker, and he said, "Oh yeah, that's fine as long as it's within your team." He didn't need an NDA signed from the other person, but if it was somebody like not within my buying team, then yeah, he wanted an NDA. Um, about the emails, because I liked the idea of the templates. How Ronald was saying he has those templates, but then Kevin, you said, "Oh no." So
Well, I'm sorry. Go ahead.
so just do you guys as brokers, do you prefer to communicate via email or do you prefer like phone calls?
For me, it's both. So, one, I'm doing so many things that generally, like if you want me to really remember everything, I need to have it in an email I can reference. But definitely when you're creating rapport with that agent, you want to be giving them some phone calls. I'm not expecting a edible arrangements or anything from people, but like I do expect some phone calls to be able to put a voice or even a Zoom to get a face to the name and to just talk a little bit. I mean, I'm not going to take Zooms all day for no reason. Like I want to be able to know that I'm getting a time investment return whenever I'm talking to people. But the emails are great. And in terms of the templating, I mean, it's something where like over the years you get used to seeing certain responses that you can tell are just like copies and pastes, or they're not really paying attention to what I might have responded to them, and they just like vomit a bunch of information back. And I'm like, all right, you had an agenda to get this started, instead of being direct, which is something I appreciate as a broker because I don't want my time wasted. They kind of like beat around the bush and then like unveiled their true intention. In terms of the templating, there's certain ways that you can sometimes get around it. And I know like ChatGPT has been a good way that some people use for their prospecting with brokers to try and get around that. And also, like if you do little things that like have your template have like one or two words misspelled, something that humanizes it to make you feel like I could look it over and be like, oh, they were like in a rush to write this out to me. Little things like that could make me mentally not think that it might have been a template.
Okay.
Also,
Um,
to that point, sorry, real quick, I want to add to that point with the template thing. We've all been in different groups. When Pace said Morby from Sub 2, when Grant from his group, when whatever person with whatever group they have, all release a script or say use this words or say this or say that, and you have thousands of people using the same exact copy paste because no one wants to change anything, and everyone decides, "Oh, I'm going to do exactly what they said because they told me to do it." What do you think an agent does after the fourth time they've seen the same exact template? Or like, the next time I see it, I'm deleting you for life. Like I don't care. You could be the next Grant Cardone. I don't care. Like I've seen it 4 times already. What's to say you're not like the last person? Like, and everyone's like, "Oh, I have a buyer that has billions of dollars." Cool. I got that 10 times from 10 different people because they're on the same group. that's just annoying at that point. Like
Yep.
the template I like for efficiency, as long as it's still you and not someone else because they told you to put it, like, not saying anyone here does, but you guys know what I mean. Like we've seen those groups, and it's like everyone started blurting out the same thing, and you're like, I'm hearing the same thing all at once because someone did some event over a weekend and everyone thinks
Yeah.
they're Grant Cardone now. It's like, dude, like I'm over it. That's
He's
one way
having
to really
his
kill a
event right now.
relationship.
Huh?
Oh, joy.
I
Kevin, get
think
ready.
Jerry Miles is over at the event. I saw him post something.
He's back now.
Yeah.
Yeah.
Oh, he's
He's a part of Grant's mastermind. So he comes out at least every quarter. And I mean, Grant's headquarters is in my backyard. He's in Aventura, Florida. So my team, we've actually done networking events at the bar across the street from the hotel he hosts the stuff at. So we just catch people on their way out. Um, and you know, I mean, we've gotten investors by doing that, but um it's true though, like when when gurus are releasing templates, don't use that template, use it as a guide of how to rewrite your own in your own voice, right? Like try and understand the message of that template and then make it yours. But otherwise,
Dude, put
yeah.
the template to ChatGPT. Let it blurt something
Yeah.
out that's yours.
Yeah, for real. I mean, if you want to outsource it completely, just do it that way. And I was on a Zoom call this morning with some brokers with KW, and we kind of had that chat where one guy was like, "Yeah, you know, I thought I was really good at copywriting, and then I took my copy and I asked ChatGPT to make it better, and it did. You know, it made it so much better that I like got jealous." So it's true. But beyond that, yeah, the templating is not a bad thing. I just it rubs us the wrong way when we see somebody being either disingenuous or too lazy to want to actually give us their true feeling or response. But like Ron already cleared that up with what he was saying about, well, you know, it goes a couple questions deeper and then is able to provide stuff. But yeah, I've when I've had buyers that ask for one thing on a listing that's like completely different. I've had people like send me their buy boxes on industrial on a multifamily listing, and I'm like, well, why are you even talking to us if we're doing multifamily and you want industrial? Like, you just email me and say, hey, I want to buy some industrial property, then I'd set up a Zoom call with you and figure out how we could buy, you know, some industrial property. But yeah, that's kind of where I take that.
So for my templates, I actually hand wrote them all
Yeah,
personally. I didn't
that's
use
great.
someone else's framework. And what I do is I personalize each one to whomever I'm sending it to. Like, you know, hey Jason, or hey Kevin, or hey Edward, thanks for sending this deal over. But unfortunately, I'm not really looking in Pennsylvania. This is my buying criteria that I'm looking for. Or if this deal's not in the market, or if I even pass on a deal, I have the framework, but then when I pass on a deal, then I actually go into details of why. Hey, you know, this deal doesn't fit our buy criteria because it's older than 1985. You know, the foundation, you know, was having issues. The electrical panels were, you know, I actually did that. There was a deal there with the electrical panels where I think um, they wouldn't be insured because of some kind of recall or something. So I actually
Yep.
put that in the email and put the link to the article. And I told the broker, hey, if you'd like to read up more about it, you can find that information here. But I put that information in my template. So I never just, unless it's like a stock, like, hey, thanks for sending this deal over. They sent me a deal that is completely not in my market just because they were kind of, you know, doing their cold outreach. Hey, I see a deal in Virginia, whereas I'm investing in Tennessee or Atlanta. Thanks for that. But we're not looking in blank market, you know, then I fill in the
Right.
blank. And then this is what I'm looking for. This is my buy box. But like everything, all my templates are, I actually had the idea because I ended up having to give multiple brokers very similar responses. And then I was just like, wait a minute, I keep sending
Yeah,
the
yeah.
same kind of responses. Let me create a template. So I wrote out the template, tweaked it, make sure that every time I send it out, it's personalized and actually includes information relevant to that specific deal. So it doesn't look like it's just a copy paste that I'm just sending out to
Yep.
someone. So you got to just use it as a framework, as a jumping off point, and then, you know, you fill in the blanks from there. That's what I do though. But, you know, I'm glad to hear that you think that's actually a good strategy that I've been using.
Yeah, doing it that way is just fine. And I was about to get to answering Marlon's chat question. It looks like he just jumped off the Zoom, but I'll still get to it. So he'd asked in the chat, how are we calculating for inflation or staying ahead of it? The fact is, inflation is such a wide varying number that the best way to stay ahead of inflation is just to be conservative on your assumptions. So we have to in the Ed, if you want to bring up that model real quick of the P&L tab, um, it we have to assume our rent escalations every year. We have to assume our expense escalations every year. We have to assume our concessions every year and what that's going to do. But the best way to protect yourself beyond those is what your expectation on exit will be. So thank you, Ed. He knows me already. So the cap rate bump, like everybody always talks about, oh, well, when we sell it, we're going to be able to sell it at a lower cap rate. And you better never, ever, ever do that. You want to build your deal based on the fact that you're going to sell it on an expanded cap rate and not a compressed cap rate. Net cap rate compression automatically makes you make money. So it's falsifying the documents to your investors and giving you that false sense of security that it's a sure thing. When if cap rates start to go up even a quarter point in your hold period and you thought it was going to go down a half a point, you got a 75 bip spread that you have to figure out what to do to make sure that your investors get the IRR that you talked to them about. So the best way to combat inflation is to be highly, highly conservative in how you underwrite your assumptions and always expect that the market will be worse than the market you're buying in. That's the easiest.
And this goes back to kind of what we were saying earlier with having multiple exit strategies. But also every deal is different in the sense of like knowing your timeline. Are you assuming a loan? Cool. What's the life of the loan assumption? For example, the Florida one we have is 9 years. Now, the one thing I love to tell every potential investor, and one thing we liked about the deal so much is, which phone call would you rather have at year 5? Hey, market is going through hell. Cap rates are crazy. Everything's crazy. Interest rates are too high. We can't get the same return, but we're not forced to make a decision today based on what we feel like the trajectory is. We have 4-year window where things could get better at that point, hopefully. And if not, there were bigger problems than just this deal, to be fair. But naturally speaking, is we're not forcing our hand in year 5. Anyone that bought anything 2020, 2021, and they had a timeline at the limit to when their loan is due, if they did a bridge and they had it at 3% interest when they bought it, or even let's say 5, and now you're looking at it's like 7 or 8. Did anyone think it'd be 7 or 8 today? I don't. You're so optimistic at that time, and like you're in such a like, oh, there's no way it can double, and then it does, and you're like, oh crap. Now, what do you tell your investors? Hey, we have no option. Like you're stuck. Like the timeline's a timeline at that point. So again, that's part of it where have multiple buffers in place and exits, and even rent. Like I know I could get 1,800. I put 1,750. Let's see what happens.
Yeah, you want to stress test the heck out of your deals and prepare for anything that could go wrong because
and things you don't know could go wrong.
Yeah, because again, anything that can go wrong will go wrong. So we have to prepare for all those eventualities. I mean, on our deal, we were projecting rents to go to 1,750 within 5 years, but we knew already that like they're already at that number. But we were telling people that stabilization of 5 years, maybe we can get there. We renovated our first unit, added laundry, new kitchen, new bathroom. We didn't even put in like tile bath. We didn't even put in a stone countertop. Like we did a lot of things that we had to shift around because due to the COVID supply chain issues and cost increases, we couldn't hit the same level of turn we would have been able to years ago for that price. Yet we had the next door neighbor who heard the hammering and everything, asked for a tour. she went in, and Ed, I actually don't know if you'd heard this yet. So the next door neighbor of our owner unit went in and was like, "Oh my God, I'd pay $2,000 for this." And we're like, "Great, we're hoping you'd pay 1750." And if we do 1750, then our investors will hit a 20% IRR. So knowing that you'll do $2,000 4 months after taking over the property instead of 5 years later, that makes us feel better that we're going to be well on track, even if other things go haywire in the process of operating the property.
And on that note,
Yeah.
uh,
So
I do appreciate the involvement from everyone on the questions.
mhm.
Um, any last minute things? If not, we are good to call it. Appreciate you guys as always. It's very good. Go for it.
If I can, just one last question.
Yeah.
Yeah,
So,
yeah, go for
you
it.
know how sometimes the OMs don't have the price, and then when you're doing your underwriting, you have the NOI, and you can use the market cap rate. Like I have, from CoStar, you can see what the market is in that location and with comparables. So then you put the price based off that cap rate and what it should be, and you do all the underwriting, it looks great, and then you talk to the broker and you get the whisper price, and it's like way over what you've done, and what you've calculated, and their cap rate is like a whole percent less. So it's like the market in that area was 8.4 and they're trying to sell it at 7.5.
Right.
And
So
it's just like, what do you do when that
yeah,
happens?
so that's twofold. So one, CoStar data, the analytics data is usually trailing by 12 months. So it's because of how they tabulate, it's averaged out from 12 months to get that. And so it's a little bit aged. So you have to be staying also on track, like when you can actually determine through like if you have a CoStar account, determining through the past solds, and the recent sales and comp sales in the area. And sometimes in the CoStar notes, it'll say like what that cap rate that property traded for. Then you have to like manually go and tabulate that stuff to try and verify where that MSA's cap rate currently is. Um, and then the other thing is a lot of sellers are crazy. So that's just something we'll never be able to get away from. I mean, I had a 700 unit deal in Atlanta fall apart where the seller would, if he'd owned it since 2019, would have made $35 million if he agreed to sell, and we were 3 million apart. And I'm like, dude, how much money do you really need to deposit in the bank? Like we were not asking for too much here. We have people to worry about. The property was late 70s, so we knew that the buildings were updated plumbing, but the underground between buildings was still cast iron. And I was like, I'm sorry, we had to put like $1 million on the side of CapEx for the just in case if we have to replace the underground pipes. And I left all the reasons on the table, and they were like, no, he wants 73 million. And I'm like, dude, our offer is 70 million. You like all the other offers in the call for offers backed away. We're the only one left, and he still won't say yes to us. And that was 2 months ago, and now the broker is calling me every week like, Kevin, he wants to reconsider, like, will you guys resubmit? And I'm like, yeah, in the 60s. Like, you lost your chance. And so now I'm trying to bring him down more because I can feel that seller regrets being greedy, and I'm going to make him pay for it. And it's just one of those things that, like, but it's also because we went back and looked even deeper at the rent growth in the area, and we got a little bit nervous with the way the market has moved in the Atlanta suburbs, that we thought that rent growth would be a little bit more stagnant than we were hoping for. And so again, going back to that conservative underwrite, we said, you know what, actually we probably would not be comfortable at 70. We'd want to see it in the 60s. And
Also to that, oh, go ahead.
go ahead. No, that's it. Go ahead, Ed.
I was gonna say regarding like the cap rate and the percentages and what the market says and what the price says. Remember the same way I was saying earlier that the NOI and like the expense ratio is relative, so is the NOI. Because if the cap rate is relative to that NOI, I'm more concerned with to is the NOI affected by any of those other factors of vacancy, concessions, loss of lease, because that could just be like there's value there, or there's things went wrong, or things that happened to the property, or units could have been sitting for whatever reason, or income is on the floor. Where if you can come in and do a quick turnaround and increase that NOI fairly quickly within like a realistic expectation, not saying I'm going to come in tomorrow and remodel 100 units. Obviously, that's not going to happen overnight, but like be realistic expectation timeline, and like Kevin has mentioned a couple of times, within like, hey, if I think something we can get done in 3 months or 2 months, let's say 4, okay, cool, do I still hit the target? All of a sudden, what that cap rate you actually purchased at doesn't really matter. No, because there's so many other external factors that's why I hate relying on the cap rate, because it's not gonna paint the whole picture, right? There's more to the story than just the cap rate. Like you could ask for like whatever percent you want. I don't care. I'd prefer the story and the actual detail than just that cap rate, right? Now, don't get me wrong. There are situations where what you're saying is 100% right, and they're just asking for too much. By all means, that could be the case, and that happens. That's fine. Kind of move on. Essentially,
But it's funny, like I'll end it with this kind of anecdote. So I went to one of the first multifamily conferences I went to years back. I noticed that there was this one gentleman, um, always wearing, very dapper looking, good suit, not a fancy, flashy at all means, but just nice suit wearing guy. And you always standing kind of in the corner, of all the exhibit halls, and he was just soaking everything in like a sponge. And so at the very end of the conference, I was like, man, I gotta ask this guy, like, what is his deal? And I walked up to him, started talking to him, and he owned over 2,700 houses in Boise. And I was like, wow, like that is that's a lot. And I was like, these are not apartments or anything. He's like, no, like houses, like entire developments. And so we started talking a little bit more, and I was like, what is your like one kind of like big chunk of advice you'd give? And he's like, don't worry about the entry cap, worry about the exit cap. And like before I had met him, I was harping on entry cap much more than I do now. And yes, it matters because that's going to determine your DSCR with the bank, right? And your debt service getting approved, and your LTV and how much money you're going to have to raise. But at the end of the day, I would agree with his claim of, focus really on, again, that exit plan. And like if you're buying at that 7.5 and the market is right now at 8, 9 or whatever, where do you actually think that in 5, 10, 7 years, whatever, you will be able to have your cap rate at? Because that's going to determine your sale value. Because you can figure out where you can take your rents and clean up the efficiencies on the expenses and everything else. But that exit cap will make or break any deal. It could be perfectly run. I was listening to the multifamily, the syndicator podcast recently, and one of the guests, he talked about this. Like, is actually the guy who's the president of Bigger Pockets, where he's like, he was harping on being diversified, and he has a little bit in real estate and a little bit in stock, and then he's like did like 3 syndications as an LP. And he was like, the operator I invested with did everything right and had a wonderful track record, but he bought at the wrong time, and now they're going to lose all their equity. Like they raised the rents to the numbers that they wanted to raise to. They did all the things they said they were going to do in their business plan, but because of floating rate debt and the exit caps, they're getting wiped clean.
whoops. Yeah,
So,
and again, there are so many factors that Kevin said.
but yeah, it's just a matter, again, that's why we take the underwriting portion so seriously, because it makes or breaks everything when we really go deep on understanding what the risks are. And if we can identify those risks, then we can build out contingency plans to mitigate them down the road. I do see, Mike, you got a couple questions here you threw in. So we would use construction cost per square foot by area being renovated to come up with the amount to raise. So no, I would never just go on a formula like cost per square foot. You really want to look at we're going through this right now on our panhandle. Like, you want to identify truly what is it you're going to do. Do you need to replace cabinets, or do you resurface? A lot of the times companies right now are going to tell you that resurfacing is more expensive than replacing. And cabinets are crazy costs right now, post COVID. So, is it cabinets? Is it flooring? Is it bathrooms, plumbing, electrical? Are you adding stuff? Like, you really want to dial in on each of the line items, because if things have to be adjusted later, that means one of or two of or three of those line items will be deleted. Right. So like we were planning on adding laundry to all 120 townhouses. That is way out the door now, because the first test unit we did, it cost $3,500 just to put in the plumbing and electrical. They had to jackhammer in through the slab to get to the pipes. They had to do all sorts of stuff. And then we also realized, after we were able to break open some walls, that because our property was built in multiple phases, one of the phases is not just we can't do it. So like that just knocked it off, and we're like, all right, I guess we'll have some money to beautify the laundry room, because again, like, if you're going to spend $3,000 to add laundry, so then it's 4,000 once you add the machine, you have to quantify what that return on investment will be. And if you're going to get a $50 rent bump for spending $4,000, how many years is it going to take to get that return? The next buyer will get to enjoy it. So yeah, don't just use a base formula like that. You want to really identify what that scope will be. And I'm going through a fund I'm a part of right now, as one of the co-GPs, another GP team where I'm not involved with. They're buying a property in Houston, and I'm scared for them, because in their underwriting, they had a full turn at $9,000. And I'm like, dude, I don't know anybody's like materials that you can turn an apartment for $9,000. And I brought it up in one of our meetings, and they were like, no, we've got contractors giving us quotes. And I'm like, man, good luck. That contractor is just hungry for a job. He's going to change order you until you're broke. But yeah,
Also,
so go ahead.
regarding that point too, Michael, you can't use that general rule of thumb too, because there's so many exterior, non-internal in-unit factors they have to keep in mind, just as well as units, AC or roof, or if there's trees, signage, landscaping, so many external factors. And then obviously, depending on location, if you have any weather things or insurance stuff that's required, that doing a per unit is just a broad, like, cookie cutter kind of thing, that you're just gonna do a shortcut that's gonna end up backfiring in a big picture. Is it more tedious? Absolutely. Is the way Kevin just explained it gonna give you a much better quote, and as accurate as you try to get, when you walk the unit, you're gonna realize you're still wrong.
Yeah, and it'll help you when you're talking to investors too, because then you have like clarity in your plan versus saying, well, we're going to do, we got this much money to do this stuff. But when you can actually point out to them, like, hey, we've gotten a couple of quotes from people, and this is what we're going to do, and we know we're going to be able to achieve it, it's a lot easier for people to get behind you. One of the last things I'll say about the CapEx stuff is, on our deal, we were not planning on replacing exterior doors, because they're hurricane doors. They're already fine. Yeah, many of them were kind of dented up. Some of them were like held together with construction foam and stuff. And I was like, yeah, sure, like those ones we can replace those ones, but not like blanket new doors for the property, because we bought townhomes. Every townhome has a front door, back door, and a storage room door. So then you're talking about three doors. It's 360 exterior doors and door jams. plus the labor. So that's like almost 200 grand. Like we in our original estimate, we did not include it. Our construction manager that's running the CapEx was like, you guys really, like, he harped on us for like a month. You guys really need to replace all these doors. These doors suck. And I'm like, they might suck, but you ain't paying more rent just for a better door. You know, you like, okay, it's dented. That sucks. If it's bubbled, fine, sand it down and repaint it. You know, let's spend some money and give them a nice kitchen. So it's getting that clarity and then being able to have the tenacity to tell people that you got to stick to the plan versus running an audible once the money's in the bank. And then raising the capex for the rehab before the close. In syndications, 100%. It must be done. 100% of your capex needs to be done in the initial offering and PPM, because otherwise you're doing what's known as a capital call, and no investor wants to hear that you need more money. If we really wanted to renovate all of our units, we would probably have to ask for another like $400,000 or $500,000, and we don't need to. Like that's where we brought our conversation back to the, where do we want to exit? And if we renovated everything, our property, in my opinion, is just kind of under that threshold of like the insurance companies or big institutional buyers wanting to buy it. So we have to leave some meat on the bone. So instead, we've changed from a blanket rehab to saying we're going to leave about 30% of our units more close to a classic, like a slightly updated classic, like to a higher standard, but classic. And then another 33%, we're going to go full bore. And then there'll be a 33% kind of middle ground. And then that way, somebody else can come in and say, hey, there's a third of the units we can renovate, and another third we can add a little bit more stuff to.
Yeah, and realize your timeline too. To say you're gonna do, obviously depends what you're buying, but to say I'm gonna 120 units to do 100%, even in 5 years, that's a big ask. Like because you're navigating so many things, especially when remember on the lending side they have requirements too. They don't want you under 80%, and then you have factors that you can't control. Like there's such a can of worms and rabbit hole we could go down that we're already so far over that we can probably say for next time of like kind of like things to know and like not assume so much. But generally speaking, yeah, like I really appreciate the questions from you guys,
Yeah.
participation. Definitely makes our calls a lot more engaging and fun and easier. Because we know what you guys want to know, and I do love that you guys utilize the chat and just participate. You guys are awesome. So I don't have much else to add, other than enjoy your rest of your week, your weekend, and we'll see you guys next time.
Yep.
Thank you so much.
Thank you guys very
Bye,
much.
guys.
Great night.